This video on making money is brought to you by courses on making money, which are in the description down below. Investing in real estate, stocks, and making YouTube videos are all available. Use that coupon code before it expires in just a few days. Hey everyone, me Kevin here. This is my stock portfolio. These are the actual amounts of shares that I own for the stocks listed on this screen. Now it doesn't show you everything, but it does show you that I own a lot of Tesla and Apple shares. And folks, I have some concerns that I want to talk about regarding the stock split for Tesla and Apple. And in this video, we're going to talk about three big things. Number one, we're going to talk about Tesla and the Apple stock split. Then number two, I'm going to talk about recovery stocks and Abbot Labs' new test and my strategy around these. Number three, I'm going to talk about my stock margin strategy. I'm going to tell you everything I think and what I'm doing with stocks right now. Remember, by the way, if you like stocks, then you'll probably also like 2 free stocks from Webull. They are ending the 2 free stock promotion this Monday, so make sure you deposit $100 with Webull and get your 2 free stocks before that promotion ends. First, let's talk about Apple and Tesla. On a daily basis, I get emails like this, folks, and it drives me mad. I get emails like this. Quote, I'm a new investor. I'm trying to deposit my money into M1 Finance. I'm hoping to get my money in before the Tesla-Apple stock split. Am I too late to buy? I really think they're going to go up after the stock split. Sincerely, and then the person who emailed me. Like these are real emails and DMs and comments that I'm seeing. There is a really heavy belief in existence right now that a stock split is somehow good for the fundamentals of a company. A stock split, as many of us watching this video probably already know, does absolutely nothing for the fundamentals of a company. It does nothing. However, Apple and Tesla, despite this doing nothing, have shot up like crazy over just the last 2 weeks. And when I say shot up like crazy, here, take a look at the iPad and look at it with me. This is Tesla. Just since August 11th through August 28th, just 17 days here, Tesla has gone up 839 points, or 61%. And you know what's kind of creepy about that is following this kind of same run-up we've got over here, check out what RobinTrack says, which tells us in green the amount of users holding Tesla stock. And as you can see, the amount of users holding Tesla stock is going up right along with the price. Kind of interesting. What about Apple? Apple has also gone up nicely, certainly not as much as Tesla. Apple's gone up about 31% over roughly the last month. And take a look at Apple over the last month on Robinhood. Lots more Robinhood users going in. It seems like every time the price goes up, Robinhood users come in right afterwards. Now, I'm a Robinhood user as well, so I'm not trying to say anything bad about Robinhood users. But what I will say is I'm concerned that we've had a recent euphoric run-up in these stocks by potentially less experienced investors who want to get in before the stock split to be a part of a stock split. At the same time, short sellers are getting squeezed out because it's becoming very expensive to be a rational short seller right now, even though it might make sense to short some of these stocks because we might see a correction. Some of them are still getting squeezed out. Now, Apple doesn't have many shorts outstanding anyway, but we do know that Tesla is like 8% short. And so, folks, there are a few things that could happen here because the bottom line is no green market lasts forever. Stocks don't go up like this forever. Tesla does have a history of doing this, though, where it tends to go up for 10 to 21 days in a row. We're at about 16 calendar days in a row of this run-up. And there are a few things that I think are possible that could happen. Number one, I wouldn't be surprised if after the stock splits that happen today and the beginning of next week, we'll start seeing prices slowly pull back at Apple and Tesla. If there's any bad publicity or bad press, it's going to be even worse, and we'll see even more of a pullback, and it would not be surprising to see people who are buying Tesla and Apple shares start selling, taking profits, and pushing the stocks back down. The reality is we have no idea what's going to happen. What we do know is that Tesla and Apple are probably very good investments for the long run. No guarantees. I'm not going to say you can hold them forever, but I'm optimistic about both of those companies, at least for the next 5 to 10 years. However, in the short term, it would not surprise me to see a substantial pullback, especially if there's any kind of fear catalyst that leads to some sort of short-term crash in these stocks. That is, I wouldn't be surprised that after the split, sometime between September and October, we might see some of these stocks pull back 20 to 30% as people start bailing out of these companies again. So here's how I'm playing Tesla and Apple and what they're doing in my portfolio. Number one, I'm only adding to Tesla and Apple as part of my top 40 stocks. So usually when a company is really suffering and it's red, I like coming in and individually buying that stock. I can't bring myself to individually buy Tesla and Apple right now. So instead, I'm putting money into what I call my favorite index fund, which is my own. It's not really an index fund, but I just call it that. You could see it at metkevin.com/1337v6. You could look at it totally for free. It's about my top 40 stocks, and you could see the different percentages I give to each stocks. And yeah, I did update it to version 6. This means I'm not individually buying these stocks. If Apple and Tesla do end up correcting downwards by 15 to 30%, I personally believe we'll have a really nice buying opportunity to get back into Tesla and Apple at lower prices. I don't feel comfortable going in heavy on Tesla and Apple right now. I'm actually doing something totally different with my cash, and I'm using a margin strategy to take advantage of Tesla and Apple. More on that in part 3 of this video. So instead of going super heavy on even this index or going super heavy on Tesla and Apple individually with this crazy run-up we've seen, here's what I'm doing instead. This is part 2 of the video. Rather than joining this meteoric rise, I'm investing some of my cash right now into my favorite recovery stocks. I've been waiting for something that's going to tell me I could feel more confident about the COVID recovery. About 1 month ago, I started noticing that Google Trends data was suggesting we might be getting to a place where COVID is more under control. It's not going to be gone, but more under control. And so I've slowly started increasing my exposure to recovery stocks, like the airlines, the cruise lines, the restaurants, and retail and entertainment. Now, we had even more of a catalyst that just happened this week. In case you didn't hear, Abbot Labs announced a $5 do-it-yourself quick test kit. The test kit is about the size of a credit card. And after you take the test, you download an app, and that gives you your results. But in addition to giving you your results, you could show your test results to people to verify that you actually took the test. I'm sure there are going to be ways to game it, but I hopefully people would be moral about this. Anyway, this presumably, making an assumption here, is going to be good for movie theaters, malls, schools, airplanes, hotels, restaurants, Dave & Buster's, and more. I wish I had more fingers on this hand to count these out. But this could be very, very good for some form of recovery. Now, I know most of us have been waiting for a vaccine, but realistically, if we have proper testing and we can isolate the people who know they're sick, and basically people can only go inside buildings if they have a green badge of some sort, that would be awesome, especially if that green badge expired every, 5 or 7 days or whatever, so that people had to renew their testing. Details to come. Obviously, we don't know all the details of this yet, but check it out. The Abbot Labs Rapid Test Kit is a game changer. Pay attention to this. Donald Trump ordered 150 million test kits at a price of $750 billion. So, look, it shouldn't be surprising that the administration is throwing money into this recovery. The more we recover faster, the greater chance I think there is that Donald Trump gets reelected. And I think all of us can agree on that, whether or not you're on the left or the right. Not trying to be political, I'm just bottom lining it here. So, here's what I'm doing. First, in my opinion, do not throw a dart and pick an individual recovery stock. Don't just YOLO and pick Dave & Buster's, okay? Because they could go bust us. All right? I'm always extremely clear about this anytime I recommend a stock. They can go down, okay? So here's what I'm doing to kind of limit the emotion that goes into buying recovery stocks. And keep in mind, this is still risky. Go to this website, metkevin.com/recovery. That is going to show you my 10 stock picks for recovery stocks. And it's going to show you how I've divided them out into different sectors, kind of like, here's the hotels, here's a bit for restaurants, here's a bit for entertainment, here's some more steady companies, here's some companies that have less risk, here's some companies with more risk. And so this way, if I want to put money into recovery stocks, I'm not going all in on 1 or 2 stocks. It's too volatile. It's too risky. It's too emotionally draining, because there's a good chance if you buy recovery stocks that they'll go down again, they'll go up again, they go down again, they go up again. It's madness. It's maddening. So if you want to play the Abbot Labs, game, so to speak, and speculate that, hey, this is good, we're in recovery mode, this is an option for you. This is something that I'm doing, not with a lot of my portfolio, with about 5% of my portfolio. So I've taken 5% of my portfolio's value in cash and moved it into these. And that's in addition to the previous, maybe 4% I've had. So I'm increasing my exposure to recovery stocks right now. Again, mostly because of that Abbot Labs thing. Keep this in mind though. All of these recovery stocks are heavily burdened by new debt, and that makes them all risky investments. Now, I chose the companies that I did because I feel like they are less indebted than their competition. So if you look at the airline I chose or the cruise line that I chose, you're going to see or know that, in my opinion, these companies are better off financially than their competitors. That's the reason for the choices that I made. Furthermore, any change in COVID could really screw this whole thing up. If we get a second wave and we start seeing data trend up again, all of these stocks are going to tank again. It's game over. So this is not for the faint of heart. Okay. That said, the stocks are up very, very well today. I mean, some of these choices are up 16% today, 8% today, 8% today, 7% today. So, the recovery market has already started pricing some of this change in. We don't know if that is going to last into next week and beyond. I am hopeful, and that's why I'm investing. Okay, strategy number 3 right now that I'm doing. Stock margin. Very, very dangerous, very risky. If the market falls, you could get a margin call, which literally means, hey, yo, you borrowed some money against your stocks. Well, the stocks fell, and now you got to bring in some more cash. You got to bring it in within the next 3 hours. Otherwise, I'm liquidating your stocks, bro. You don't have any cash? All right, I'll liquidate your stocks now. Yeah, that is a margin call. So it's dangerous because you don't want to lose your stocks at the bottom of the market if there's some kind of crash or double dip, right? So here's what I'm doing. I'm not using margin I'm trying not to. I'm paying off the margin that I have with Webull, Robinhood, and TD Ameritrade. All 3 of these brokers, they charge you higher interest rates, and, well, ultimately, they let you borrow probably more than you should. They let you borrow up to 100% of your assets at Robinhood and Webull, and at TD Ameritrade, you could go even crazier than that. I won't even mention it because you could go crazy at TD Ameritrade. Very dangerous. So instead, here's what I've been doing. Every time Tesla and Apple shoot up, I go to M1 Finance, and I know I keep mentioning M1 Finance. I get it. I use them a lot. They're my main broker. 90% of my stocks are with them. M1 Finance lets you take out up to 35% on margin. That's less risky than taking out a full 100% debt against your stocks. Obviously, with less risk comes less reward, but look, I don't want to lose things, okay? I do not like losing money, so I am limiting my risk. And so with M1 Finance, I'm limited to 35% debt, 35% margin, which is good. Every time Tesla and Apple go up, I'm taking the cash out and I'm just letting it sit in the brokerage account. That way, if Tesla and Apple fall, my ability to take out more margin is going to go away, but I'll have cash to buy Tesla and Apple. Now, if the stocks fall so much that I get a margin call, I could take that cash and return the cash money to margin if I needed to, right? So by keeping it in cash, I'm insulating myself, but I'm also preparing if I see a 20% pullback, great. What I did to make this make a little bit more sense is I went ahead and put together a quick PDF that'll show you how this works. Let me pull it up. So take a look at this. With M1 Finance, if I have $10,000 in value at M1 Finance, that means I'm eligible to borrow $3,500. That means if I invest that money, I have $13,500 invested, if I invest it. If I put it in cash, then obviously I have less invested. If I have $13,500 invested, M1 Finance is going to require me have 30% maintenance, which bottom line, and I don't want to go so crazy detailed in this. I could do that in my stock and money course, which I'm developing and adding lectures to right now. Here's the thing. With M1 Finance, for me to get a margin call, stocks would have to drop slightly more than 44%. That's a lot. That's almost halving in value. I don't expect my stock portfolio to fall 44%. Could it happen? Yeah, and that's why I am keeping some money in cash. However, if I went to Robinhood or Webull, stocks would only have to drop 25% before I got a margin call. And so that's why I'm a little, and that's with 100% margin. And so that's why I'm a little bit more hesitant over at Robinhood and Webull to keep pulling up margin. So just be careful. That's kind of just like basically a quick little warning for you on margin. The more margin you take out, the quicker, obviously, you would be exposed to some sort of margin call. So this is how I am preparing for this evolution in the stock market, which is basically already happening. So if you like this sort of information, the way I present my perspectives and ideas, consider learning from me on everything that I've learned in the last 10 years on investing in real estate and stocks and how to build money, a portfolio, and manage your finances. All of these courses are available in the links down below, and you can use that coupon code. Quick summary. Number 1, Tesla and Apple. Be careful. I wouldn't be surprised if we see a big pullback in these and another buying opportunity. If you're going to invest right now, consider, if you have a risk appetite, putting some of your money into those stocks at metkevin.com/recovery. It doesn't have to be through that portal. It doesn't matter. You could just look at that portal and pick the individual stocks if you want. Then, when it comes to margin, be safe, be careful out there. And honestly, if you use margin, you really ought to have some sort of regular income coming in. So that way, if things started kind of declining, you'd have cash that you're able to build up every week to where you could slowly bail yourself out of some debt if you needed to. So be careful. If you're unemployed and you don't have a lot of money, stay away from margin. In all fairness, stay away from margin. It can be very, very risky. So there you have my update on the stock market and my concerns. If you've liked this, please consider sharing it with anybody you know that cares about money, which is hopefully everybody. Thank you so much for watching, folks. We will see you next time.